Good morning. It is the week of June 27th. We are doing another variable rate update. Hey, I want you to make sure before we get into today, please do go back and watch our previous videos of the past few weeks. We've talked about, what are the options, what you could do if you're scared with a payment. We don't recover it all every week. And so these are worthy videos to check into. And I cannot emphasize enough, if you are frightened or you want to go through your personal options, please schedule a time individually to go through it, regardless whether you got your mortgage from us or you're looking at, getting a new mortgage. I mean, we could make adjustments if you got your mortgage from RBC or you got your mortgage from a credit union or anything like that. We could be helpful in that regard as well. I want to focus this morning on a variable update. We're looking at July 13th being the next variable update, Bank of Canada meeting where the variable is going to change. It's all but guaranteed now that we are going to have a 0.75% increase. There is some chatter about a 1% increase. We've gone through what we're going to do when that happens. We've gone through, why it's a little scary. What I want to hone in today is what do these next 24 months look like? So I cannot emphasize enough what has really happened here is that two concepts, and we talked about this before, but this is important. When an economy is strong, rates go up. As an economy is strong, rates go up. Housing prices are strong, consumer prices are strong, people are spending a lot of money, rates go up. And so we are at the tail end of that, a tail end of a strong economy that kept low rates as a result of Bank of Canada policy. Tiff Macklem, the Bank of Canada governor, said we need to keep rates low because of the impact of COVID-19 on Canadians. And so that's why they kept rates low. And so we're seeing what is meant to be, 3 years worth of, rates changing happening over the course of a few short months. The other thing that has happened that is very meaningful is the chances and the likelihood of a recession has increased substantially. And so what we have here is we have a recession on the horizon, and very quickly, and the best tool of countering recession is to lower rates. And so when a recession is happening, there's not growth happening, all those types of things, rates get moved down. Now, where is this point where we're going to see rates stop going up? I think, we're very near the static point where they don't go up much more. But where is that point where rates start to go back down again? So when people talk about, this is an interesting thing right now, because people go, oh, I would have been better on a fixed rate. And we kind of tease around that subject. But the truth is that is still by no means guaranteed, in the sense that every client we have remains to have still been better on a variable. I mean, yeah, it can logically say at this point that, if you may, depending on when you took out that variable, you may, in a short amount of months, you will start having it paid more interest on that variable over a fixed. If you haven't incurred a penalty, a lot of asterisks on that note. But what people are not thinking about is that, are we talking about another 4 years of rate increases or rates being the same, and that historically would be really inaccurate. We're now looking at a situation where, when is the point where rates go back down the other way? Okay, so issue. I think that point is about 12 to 18 months. Okay, I think that we have some data that points to a recession coming the end of this year, beginning of next year. I think there's some really some good thoughts around that. One thing being is that for rates to come back down, you're going to have to see consumer pricing to be completely leveled off. So people are spending less on consumer goods. They're not buying TVs, not going on vacations. Right now, we're having a lot of pent-up demand on these types of things. People haven't done it for a couple of years. On top of that, what we have right now is we have people sitting on a surplus of cash. So that means they have a lot of savings. So rates going up, okay, fine, but people are sitting on a lot of savings, and for a lot of people, that's not necessarily affecting them. They're still spending a lot of money. And so remember, the goal of lowering rates is even though the Bank of Canada really is throwing caution to the wind and they're not following this and all those types of things, they do need to. They are trying to make it so that inflation slows down. So inflation's still going red hot. Inflation is going red hot because of a number of reasons. Lots of those reasons, not things that rates can change, but they want to look like they're doing everything they can, which is what the Bank of Canada is doing. So what's going to take it for rates to go back down, which I think happens within the next 12 to 18 months, and puts us into some lower rates environments in 24 months down the road. We're going to see spending stop. When is that spending going to stop? That spending is going to stop when people deflate their comfort level of savings. It's not true that people will deflate all their savings, but there is a certain amount of discretionary income. I'm saved up a certain amount of money that I'm comfortable blowing. And the truth is, the faster they move up rates and more frequently they move up rates, that people will hold on to more cash. They will hold on to more cash, and that inflection point will come sooner. And I think that realistically, when we go into the summer, a lot of people wanting to get a really good summer vacation in. It's very easy to predict this point at the beginning of the fall, and that's not the case, and people have really reined in spending. Once we get through all of that and demand goes down, we're going to see inflation cool off from that perspective, and so that's going to make a big impact as we start to see an impact again into the retail, restaurants, entertainment, all those types of things. That's when you're going to see rates cool off, and so this is the point that you're going to see rates go back. They're going to become static and then go back down again when there is not enough growth happening. This is sooner than you think, and the Bank of Canada realizes, markets realize this. This is why rates are going up, because like when you have a rate, the prime rate that at one point was 2.45, you have a mortgage of 1.45, and if we leave that in place, recession happens. We're trying to stimulate things and trying to get people to go and do things. Like it's just like a store that has these sales or something like that. Then what's going to happen? There's not enough meat on the bone. And so we see that is certainly the case as well. The other thing that's going to happen at some point, and this is a bigger conversation, is that we're in a series right now where we have a lot of quantitative tightening. There was quantitative easing, now it's quantitative tightening. Now that involves buying back of bonds and some things like that in the bond market. That flip is going to switch at some point. I think that's going to come back this year as well, and that will also start to ease pressure on rates and those types of things. So message right now, hold tight. Don't be afraid if you want to run through the moments. We've done tons of clients this week through our 7% test to find that so far when we do a 7% test, everybody has decided not to change their mortgage. That they're like, hey, not perfect, but I can make that work. So if you're scared, you want to run some real numbers, let's get together and do that. We love the idea of that. Now, if you have a friend that has a variable mortgage, please share with that. We also really want to get our subscribers up on our YouTube channel. We can share this information with as many people as possible. Would you do us a favor? And if you haven't subscribed to our channel and you're a client of ours, just go ahead and subscribe. Helps out a lot to get our message out, and that would be of great value to us. Have a great day. We'll talk to you soon.